Most people never think about the plumbing of the financial system until something breaks. That's part of the deal. If the pipes are working, you don't need to know how the water flows. But when policy starts rerouting that flow quietly and over time, the risks don't disappear, they just move. A few weeks ago, I sat down with Professor Jill Cetina to talk about exactly this: how, since the financial crisis of 2008, the system's operating assumptions have changed. How liquidity moves through the system now differently from how it did then, and how remedies like quantitative easing, which were necessary to solve the 2008 crisis, may have quietly reshaped the financial architecture beneath the surface of our system. What looks like stabilization on the surface may, in fact, reflect a deeper structural shift, and unwinding it may be far more complicated than we expect. And unwinding it may be far more complicated than it sounds. At the time, this was a conceptual conversation. But since our conversation a few weeks ago, the Federal Reserve has made this question concrete by proposing new regulations about how banks have to relate to liquidity. Newly proposed changes would loosen and streamline parts of the post-crisis capital framework. Regulators are moving to simplify how large banks calculate their capital requirements. They're recalibrating the GSIB surcharge, and they're easing capital treatment for certain activities like mortgage servicing. Again, these are not things most of us spend most of our time thinking about, but taken together, the effect is a modest reduction in the required capital levels across much of the banking system. And it's justified on the grounds of that the current rules may be overly complex, distort lending, that they might push activity into less regulated non-bank actors. And on paper, that is an efficiency question. But in practice, it may be about something else. Because if Professor Cetina is correct, the system we're trying to optimize has already been fundamentally and structurally changed by the post-2008 realities. Years of quantitative easing didn't just add liquidity, they changed bank balance sheets, creating large volumes of uninsured mobile deposits and a system more sensitive to shifts in confidence, and a system more sensitive to shifts in confidence than it appears. And that's where the real question begins. When capital requirements are eased, when liquidity is assumed to be available, and when risk is redistributed across banks and non-banks, who is actually bearing that risk? Because most bank customers are not intending to be creditors. They're not intending to underwrite duration or liquidity mismatches and risks. They're parking cash, and they understand that there's a measure of this that goes on to create the incentives for banks to give them a place to park cash. But when the structure shifts and when risk management changes, the risks don't go away, they settle elsewhere. And sometimes they settle on the very depositors who rely on these banks. And if all of this is being done in a way that also makes it conveniently too easy for the federal government to borrow, then we're in a position where liquidity risk at the banking level and at the level of the financial system is feeding into federal government dysfunction and vice versa. And the risks that are being moved around there are not being evaluated or discussed. They're certainly not being voted on. And Professor Cetina is animated, as you'll see in our conversation, about this very reality. Thanks so much for joining us on Gross Domestic Problem.
Welcome to Gross Domestic Problem, the podcast that tackles America's biggest and most urgent crisis head on. The economy is on the brink. Americans feel it. But what if the real cause of the squeeze in their bank account, like an iceberg about to sink a ship, was mostly invisible? That iceberg? The national debt. Every episode of this show will be focused on unveiling this slow motion disaster. How do we get here? What happens if we don't get it under control? And what's the least painful way out? And what do we do in the meantime? There is no do-nothing solution, and every solution will require some sacrifice. But refusing that pain for ourselves means handing it on to the future with little to no control over who it hurts. And if you're like us, that's unacceptable. So let's dive in.
Welcome back, everyone. You probably did not wake up this morning thinking about the plumbing of the financial system. Most people never do. That is until something breaks. And honestly, that's probably healthy. If everything is working, you don't have to know how repo markets clear or how the Fed manages reserves any more than you understand how your city's water mains work. That's the benefit of an advanced high trust society. But here's the catch. When those pipes are mismanaged, the risk doesn't disappear. It just moves, usually onto people who never agreed to take it and aren't prepared to deal with it. That's a huge part of this show's origin story. When we talk about fiscal irresponsibility, as we often do, we talk about borrowing capacity from the future. But there's another unacknowledged transfer happening at the exact same time and by the exact same path, a transfer of risk. Policymakers make decisions about liquidity, debt, and financial regulation that quietly shape whether the system is resilient or fragile when the next shock comes, like a recession, a regional bank crisis, perhaps even a war. So today, we're pulling back the curtain on some of that plumbing. And with me is Professor Jill Cetina, who has spent years studying and working inside the structure of the financial system. And she's here to help us today understand how liquidity moves, why the Fed's balance sheet exploded after 2008, and again after COVID, and why shrinking it has proven so difficult, and why, at last, any of that should matter to you. And the question I have underneath all of this is fairly simple. Is the deal still real? If you work hard, save well, play good defense financially, are the institutions that underpin the American dream strong enough to hold so that that decision can pay you out the way it is meant to? Thank you so much for joining us. Professor, thank you so much for joining us today.
Thank you, William. I'm so pleased to be here. These are important topics that you all raise.
And before we get started with any of that stuff, I just wanted to give you a chance to let people know who don't know who you are yet. How did you come into this world? What sorts of bad decisions and judgments and lost bets led you to be a person who knows more about the plumbing of our financial system than anyone else?
So, no, thanks for that, William. I'm the kind of person that I always start to recognize when I'm in a role that I'm brushing up against something else and I need to learn more. And so I started my career at the Treasury Department. I spent 10 years at the U.S. Treasury Department. I was both an international economist and a financial economist. In my role as an international economist, I represented the U.S. government in international debt negotiations with other countries when they owed us money and were having big macroeconomic imbalances and were unable to pay back our U.S. government agencies. And then I moved on and I was in Treasury debt management. I was involved in the issuance of Treasury securities for about 4 years. From there, I went on and I worked at the Federal Reserve. I worked at the Fed during the 2008 financial crisis, involved in discount window and liquidity facilities that the Fed put on during the 2008 financial crisis. I've also been a bank regulator. I worked at the OCC and at the Federal Reserve Bank of Dallas in bank supervision, and was involved also in monetary policy formulation, particularly around the Fed's balance sheet. And then before I became a professor, my last stop in all of this was I was an associate managing director at Moody's Investor Services for U.S. banks. This was during the time that we had the 2023 U.S. banking crisis. So right. I love interest rates. I love liquidity. I love the plumbing. I love financial institutions. I love the bond market. So all of those things, I think, are very interconnected.
Yes, and I'm that's why I'm thrilled to have you here. You've seen how the sausage is made. You've seen how the sausage is coated. You've seen how the animals are slain to get the sausage. You know this thing inside and out. I'm excited to bring you into this. And I think for most people, what you call, you said, I love interest rates. And I immediately thought, well, most people would call these disinterest rates. This is not a thing that most people know anything about. So I want to start there. And really, this is a question about how emergency powers are easy to grant and hard to revoke. Most people don't understand even why it should matter. Maybe even that the Fed does have a balance sheet, let alone why it should matter what's on it. So I really just want to start there. If you had to explain it simply, what role does the Fed's balance sheet play in keeping liquidity moving through our economy? And why did it grow so dramatically after 2008 and again in the wake of COVID?
Sure. No, those are great questions, William. I'm going to go back in time to 2008. And what happened in 2008 was we had some major, I'll say, failures in terms of bank supervision. Okay. And there was literally hundreds of billions of dollars of liquidity that had to be provided both to domestic banks and also to foreign banks on the part of the Federal Reserve in order to try to stem that crisis. At a high level, we did this discount window lending, which is the Fed providing, these are liquidity injections, loans to specific institutions that are supposed to be temporary and time bound. But the issue was, of course, that problems in 2008 caused such a macroeconomic contraction, right, that if the Fed had just allowed those discount window loans to roll off, what would have happened, William, is we would have had potentially something almost severe as the Great Depression. You cannot, as the central bank, contract liquidity in the midst of a crisis. You can inject liquidity, but in the midst of a crisis to try to contract liquidity, which is what allowing those loans to roll off would have entailed, that was impossible. And this is why this was the birth of QE. So the Fed was able to maintain this larger balance sheet and this liquidity provision overarchingly to the U.S. financial system by basically going in and buying long-dated government securities. And the Fed, you have to understand, the Fed literally can create electronic money through the FedWire system. So the Fed can credit any entities, banks, who have accounts in FedWire with a deposit or, basically write up their balance at the Fed and then buy securities. So this is the beginning of QE, and we've had 4 rounds of QE that the Fed has undertaken since the financial crisis. We now are also in a period where there are what are called reserve management purchases going on by the Fed. We can, if you're interested, talk about those or not. But the big picture here is also that QE at the time, we got down to the zero lower bound in terms of the Fed funds rate, and QE permitted the Fed to lower long-term interest rates because the Fed was buying long-dated government securities. And when you purchase those, you can drive the 10-year yield down, you can drive mortgage rates down, and that can spur economic activity. Now, the way I see this story is too much of a good thing becomes a bad thing, right? And so there's an interaction here with fiscal policy, which is that, you start to run, you've got budget deficits that are increasing, and the central bank effectively holding down the term premium on long-dated government securities makes, I'll say, fiscal policymakers in Congress think that running large budget deficits is free. And so I do think the Fed inadvertently created a codependency that has become, I would say at this juncture, somewhat pernicious, in terms of fiscal policy, and has enabled, I would say, inadvertently out of the crisis, unsound fiscal policy. 2020 is a little different. COVID is a little different. We literally had the global economy have a heart attack, okay? Because COVID stopped the flow of goods and services throughout the global economy, and all of the trade, a lot of trade in the world is done based in US dollars. So the Fed needed to provide dollars literally to prevent the global economy from having a heart attack. Mm-hmm. But again, I come back to, like any good thing, too much of a good thing becomes a bad thing. And this combined with significant fiscal expansion during COVID sowed the seeds for inflation that followed, where we got CPI up to 9%.
Right. So in 2007, the Fed's balance sheet was roughly $900 billion. And in 2022, it was 10 times that. Leaving aside the fiscal policy dimension of this, which we are going to come to later in our conversation, I just want to talk about like what are the stability ramifications of an increase in the balance sheet by that? Because when the balance sheet increases like that, what that also does is it explodes the money supply. And by 2022 or so, something like there was a 36% or something like that. You know those numbers better than I do, I know, but something like a 36% increase in the total like money supply. What does that do to the economy? I mean, and to the financial system as a whole, leaving aside the codependent fiscal dimensions, which we'll talk about later.
Sure. So when you inject that much liquidity, you're going to levitate asset prices. And that is what happened across a variety of asset markets. I do think the asset market in which it's most unfortunate that was levitated was actually home prices. Because as is much discussed today, we do have an affordability problem in the housing sector. And, we have home prices very much out of line with wages and income. And that, those extremely low interest rates, right, that happened. I mean, we had, I want to say the 10-year Treasury yield at one point during COVID was driven all the way down to 70 basis points. Okay. So in doing that, that meant that the 30-year fixed rate mortgage, those rates became, as we all know, 3%. And that has effectively locked up much of the housing stock where people are unwilling or unable, in some cases even, to think about moving or selling their home because that rate is so so favorable that it just doesn't make sense.
Right. Yeah, as a person who bought both at the bottom of that market and subsequently at the top because we had a child and needed a slightly larger house, I have felt that for sure. I think in some ways the great thing about having bought at the top of the market, I've regretted it many months since, but having bought at the top of the market, I do realize that I have flexibility that other people don't have, precisely because that's a baked in part of how our house does its budgeting. We're living in that reality, and actually rates are at about the same rate or lower, slightly lower than they were when we bought it. That wasn't the case when we upsized from our smaller house to the bigger house. That really hurt us a little bit. And so I do see that's the thing too. But also you mentioned that that brought the cost of credit down. So people got locked into mortgage situations, but also the cost of credit was also was one factor. Another was the actual price of the homes that went up. I mean, you have a kind of double. It's almost like a left and right hook at the same time, right? You have house prices going up and a rapid appreciation, and at the same time, the credit's easy to get, so the appreciation isn't felt until it's too late.
Yeah. No, I mean, but we could. Housing is one aspect of it, but we levitated the stock market. There's a number of things that I think it's fair to say, I would make the argument that, easing policy to such a significant degree is part of what has enabled AI to take off. So, that's you could do a whole podcast on AI bubble, not bubble. We don't have to go there. But I think that, monetary policy and expansionary fiscal policy created very easy credit conditions that have allowed tech and software to and AI to really, I'll say grow and blossom, even as some other parts of the economy have faced challenges.
Right, and you've talked. I mean, part of the post 2008 and post 2020 world is that there are a lot of people, both in the Fed and sort of the commentariat on the Fed, have suggested that. That the right thing to do is something you mentioned, quantitative easing, which is when the Fed buys a bunch of stuff and injects cash in the economy. Now the trend is, it seems like dominant trends in thought are towards quantitative tightening. In other words, offloading the Fed balance sheet, which has liquidity implications for the economy that I want to talk about. But just staying here on the macroeconomics of it, first of all, what's the advisability of quantitative tightening in the current environment, and to what extent? I mean, obviously, you said before that too much of a good thing is a bad thing, which implies that not all of it was bad. Similarly, with quantitative tightening, is there a measure that is sort of a sweet spot? Are we tempted to overshoot it? What is when you see the dominant conversation now around tightening? What are you hearing, and what do you think?
Okay, I have a very sharp and discreet critique of this, which is that the people that, for lack of a better word, got us into this situation are not the people that are going to get us out of it. Why do I say that? Because one of the things that was ignored in terms of QE was its effect on the banking sector. And this has been a focal point of mine because I am a person that I think both about fixed income, what the Fed is doing, and banks. Okay. And so we talked about that QE, the Fed is buying long dated government securities. It buys it through FedWire. And those purchases actually have potential implications on bank balance sheets. Okay. So let's make sure that the listeners understand this point.
Sure.
If banks sell their own government securities to the Fed, it's just an asset swap. It's just, the banks get cash balances in an account at the Fed, and they give the Fed their government securities. That's not what's happened in all 4 rounds of QE in aggregate. What's happened in all 4 rounds is that banks have helped their customers, their non-bank customers, sell their government securities into the Fed. These might be hedge funds, an asset manager like a PIMCO or a WAMCO, anything like that. Those are the entities that have sold government securities in QE to the Fed. And that means that uninsured deposits are created in the banking sector through QE. Why is this important? Because if it's just an asset swap, it's not that necessarily a big deal. The reason this is important is by creating those uninsured deposits, do banks understand that if the Fed starts to shrink its balance sheet, that it affects not just the asset side in terms of liquidity, but also the liability side? Now, we also know that once you do QE, initially, bank A, B, and C might each end up with, $20. But over time, those balances are going to move around. And then there are also uninsured deposits that in aggregate have been created, and those move around. So you can end up with some institutions that are very unbalanced, where they have significant asset liability mismatches, where they've got high levels of uninsured deposits and maybe not adequate liquidity. A bank like that was Silicon Valley Bank. Okay.
Right.
And so if banks do not understand how QE impacts them, and they are not encouraged by bank regulators to have sound liquidity and interest rate risk management, you will have either bank stress or, as we saw in 2023, bank failures. So all of the people that continue, and we just had examples, unfortunately, William, this week, where we had 2 senior policymakers. The Biden administration argued for this, and now we've got the Trump administration arguing for, let's not have so much liquidity in the banking sector. Banks can come to the discount window instead.
Right.
Okay.
Right.
Why is this a problem? It's a very big problem in a world where inflation is above target. Okay. And where we have lots of geopolitical shocks and commodity price shocks that can keep inflation going. Because if I, as a bank, do not have liquidity on my balance sheet and I have to go borrow it from the Fed, that actually reduces my profitability in the moment that I do that, right? Rates aren't falling, rates are stable and or rising. This is going to reduce my profitability and make me potentially look like a weaker credit in the market, potentially spook my depositors.
Yeah.
Right? So these are very bad ideas. It mostly relates to getting the macro regime wrong. But, the people that are proposing these things, they've gotten everything wrong up to this point. So it's not surprising to me that they continue to get this wrong. I mean, I'm sorry I'm this blunt, but after 25 years in this space, that's my view. My view is that we have people who do not see their own role in continuing to contribute to fiscal excess, to inflation, and they continue to behave like, we'll just keep on in this fashion.
Right. You mentioned that. You mentioned the role that inflation plays in in creating this vulnerability to banks. And I just wanted to talk about that. Like I didn't some of this data post dates even when you and I discussed what we would talk about today. But I did want to mention that I did see that after several months of going down, core PPI, which is PPI excluding food and energy, came in at 3.3% annualized this past week, and also that today the non-farm payroll, completely reversed expectations. I think the expectation was that 50,000 jobs would be added to the economy over the month of January, and in fact, what happened is that we lost 92,000. So this goes back to something that I think like the last three. I think over the course of the last three FOMC meetings, when Jerome Powell has given his post-rate decision press conference, he's mentioned that that one of the difficulties that the Fed is enduring right now is that inflation is a little sticky, but unemployment is also creeping up, and so that means which I think in some ways like makes the Fed's playbook a little bit unhelpful. It's hard to know because it's hard to know which of those two things to pay more attention to, and it's also hard to know what to do to remedy one that doesn't exacerbate the other. So I just want to get your commentary on this point, because you mentioned inflation as an issue for banks that are vulnerable when the plan for them is to borrow from the Fed, but when the macroeconomy is also showing signs of maybe a contraction, then the depositor base of those banks is also going to be showing some vulnerability. So I just want you to kind of say a little bit more about what you see as the vulnerabilities for those banks and what Fed policy ought to be in light of that reality.
So these are great questions. I think that first, let me start with this. Stagflation is the most difficult scenario for any central bank to manage. And stagflation, just for the listeners, I know you know this, William, but this refers to, when you've got kind of weakness overall in the macro economy, a weakening labor market, as you highlighted in the NFP that came out, the non-farm payroll. And then you've also got inflation above target and rising. I do expect it's to me incredibly plausible that we end up with CPI at a 4 handle and possibly even 5. Because I have a negative view about where oil prices are going.
Yes, I mentioned. Yeah, all of those numbers predate the launch of hostilities in the world's energy breadbasket. So I did want to just throw that in there too. Yeah. So please add that into your commentary, like as you think about this. Like,
So I think that what people don't understand is that energy price risk is exponential. Okay. I have lived in Texas, for more than a decade now. I'm not originally from Texas, as you can hear, but both in my time at the Dallas Fed and then just in my personal life, gotten to know people who are active in energy, and I enjoy learning and talking about that. So in any event, where am I going? We have this situation where energy in the Persian Gulf it's building up. Okay. And, we're not able to, the oil producers, nat gas producers like Qatar are not able to get their product out. And the reason that this is a problem is that at some point storage fills up.
Yeah.
And if storage is full, then they have to just basically
slow down
production. No, shut in production. When you shut in production, all kinds of technical things happen, like you lose pressure. There's a lot of things to bringing production back online, and this can take weeks. Okay. So this is how you can have prices go parabolic.
Right.
And I think we are seeing early phases of that. I do think that if we get another, say, 2 weeks of the Strait of Hormuz closed, it is conceivable that we could end up with West Texas Intermediate, which is the relevant crude benchmark of the United States, at $150. That would not surprise me. Okay,
which is nearly double its price from a couple weeks ago, right? I mean,
right. Year end, we were
like around 75.
Year end though, we were like year end 2025. We were at like 56, 57. 50. I want to say. So this is a meaningful move in 2026 up in terms of, and energy prices, of course, they're inputs to so many other goods and services in the economy.
Right.
So it creates inflation pass through. The Europeans are in a very bad situation. But to bring it all the way back to, banking, stagflation, just like it is difficult for central banks, stagflation is the worst macroeconomic scenario for banks because you will be stressed on credit, right? Because the economy is facing credit challenges. You will be stressed on liquidity, and you're potentially also going to be stressed on interest rates because rates are not coming down to help you kind of, have an improvement in profitability. When central banks cut interest rates, that usually helps banks in terms of their funding costs and improves their profitability and improves their ability to potentially absorb loss. If you're in stagflation, you don't necessarily get those rate cuts, and that adds another layer of stress to the whole situation. On the situation that we're in, very discreetly for your listeners, my view is that we are at a rising risk of a recession. And even in the United States, even with our fairly favorable oil situation. And why do I say that? I see three vectors of macroeconomic stress out of this environment. The first is the obvious: if oil prices are high, that creates, I'll call it demand destruction in other industries, right?
Right.
I explained it to my students in my last lecture before spring break this way. I said, guys, if you only have a fixed budget and it costs you now more to fill up your car, you're going to consume less beer. And they got it immediately. I said, that's the essence of demand destruction.
That's what I've been thinking about all day. It's just like, what's going to happen to my beer budget?
Your beer budget, right?
Yeah,
and when you're talking to college students, they immediately get the beer budget. So that's the essence of demand destruction. So that's vector number one. Vector number two is, and we're seeing this already play out, declining asset values, right?
Right.
So this type of stagflationary environment, history would show us that very few assets perform well in this environment. That means stocks and bond prices have the potential to both go down here. There is no, I'll say, 60-40 portfolio hedge, 60% equities, 40% bonds. In most macroeconomic environments is a great hedge. Doesn't work here. And so you have a loss of wealth. Well, we've all been talking about the K-shaped economy in the U.S. That K-shape has been supported by high asset values, rising asset values, financial assets. And if that goes away, that kicks another leg out in terms of demand. And then my final third prong of why I'm worried about recession risk relates to all of the credit challenges we already see taking place in private credit.
Mm-hmm.
So those are the reason I believe that we are at elevated recession risk. But as a central bank, you cannot respond, I don't think, at this juncture to that. This is the unfortunate mistake of letting inflation be above target for 5 years and not getting inflation back to target, is that when we have a shock like this, you have less flexibility. And I feel that the committee has made a major error in, and plus, I also believe that we, do have challenges with regards to inflation expectations. It's all going to come down, William, to, trying to balance these things, but they would have been better balanced if we had gotten inflation durably back down to target earlier.
Yeah. Yeah, there was a policy shift in the Fed coming out of COVID, and you can be brutally partisan about this, but there definitely was a shift to tolerate elevated inflation, and in the hopes of performing a soft landing post COVID. I think and that's. The Fed has alluded to that being a policy shift that they're reversing, but at the same time, they've been. I mean, this is again referring to Chair Powell's explicit comments in the press conferences post rate decision, the last three cuts, or the last three meetings, that they're prioritizing unemployment and taking a calculated risk with inflation above target and still cutting rates. And the point is, obviously, in a stagflationary scenario, you're actually taking bullets out of your gun, for to use a very crude example. because there's less they can do. So I want to put a button on this conversation because really quickly, just to hear you say, like, imagine that, that the board of governors calls you and says, Professor, we recognize that we've made a dog's breakfast of this. Here are the things that we see happening in the economy. You've convinced us. Now what? What ought they to do?
So I would first abandon I'll call it nonsensical idea that, and I want to come back to QT for a second. I think the problem with QT, in addition to the rate environment that we've already talked about, is that banks have run their balance sheets in a manner, William, that they've assumed that liquidity will be there. And that includes, providing loan commitments to private credit, a number of things. So I would first take that off the table, right? I think I would also, so number one, let's just put QT in a box and say we're going to try to maintain a stable balance sheet. I would close the overnight reverse repo facility for money funds. I would not be extending master accounts to crypto and to stablecoins. I think that ultimately this is a potential extension, right? Okay. What people will say is these things right now are not going to give discount window access to crypto or to stablecoin. I would emphasize right now. As soon as you sign them up for a Fed account, you're starting to walk down the street of, expanding the Fed's credit provision to other areas outside of the banking sector. And I think liquidity provision, and I think that is undesirable given what we've talked about so far.
Right.
On the policy rate, I think this is unfortunate, right? You're going to have to sit back here and sort of see what happens in terms of, oil prices and the conflict itself. I mean, the conflict is its duration and its scope is driving oil prices. I don't think that if foundationally, right, let's say, William, somebody blows up a major production asset in that area around Iran, could be that the Iranian oil fields get set on fire. It could be somebody decides to hit Qatar's nat gas, or, goes after Aramco's assets in Saudi Arabia. Whatever it is, if something like that happens, Fed rate cuts, they're not Fed policy is going to have to focus on trying to cushion the economy from that. And it's going to be a very difficult environment. I do think that you're going to end up in a recession. You're going to end up having to pull out a lot of tools. I think you're going to need to be careful about not expanding credit provision to non-bank financial institutions. I think that is a real risk here. We have allowed the non-bank sector to grow. It's continuing to grow with these stablecoins that are being created. And I just think extending central bank credit or liquidity, I'll call it liquidity, but it basically, in effect, becomes credit even further, becomes yet another enabler of questions around, fiat and trust in our dollar, which is a part of what's going on with fiscal and monetary policy.
Yeah. And the long-term danger of this is what? The thing is the macroeconomic scenario, at least it's capable. I think it's open to a pretty bleak read. And the temptation, I think you're laying out very well, the temptation that the Federal Reserve will have to overshoot and to make some crucial mistakes that would extend Federal Reserve credit to institutions that are that are just not bound by the same sets of rules. What's the long-term play here? Is it that the federal government is going to have to bail out a stable coin? Like what do you what's the thing that you fear here?
Well, so let's talk about stablecoins for a minute. We have Genius Act and non-Genius Act compliant stablecoins. And so the Genius Act compliant, these are just for listeners who may not be as dialed in on the whole stablecoin topic. Genius Act stablecoins, this was passed in July 2025, and it's got, very specific, limitations to be a Genius Act compliant US dollar stablecoin on, you need to mostly hold treasury bills, and there's even a limit on, they have to be very short maturity. So all of that mostly sounds fine, except that I'm not convinced that consumers understand well the difference between Genius Act and non-Genius Act compliant stablecoins, because we haven't really spent much effort that I can tell in terms of educating them. And so when we talk about the non-Genius Act compliant ones, they can hold corporate loans, they're holding Bitcoin, they're holding gold, they're holding a whole bunch of different stuff, which is price volatile.
Right.
Stablecoins are supposed to have one-to-one collateral backing for every coin that they issue. They're supposed to have at least $1 worth of, on a mark-to-market basis, collateral, right? And so if they're holding the non-Genius Act one, stablecoins are holding more things like this, and they effectively break the buck, to use a money fund term, or depeg, to use the stablecoin term, then what you end up with is the risk of a loss of confidence. And we've seen that. That actually was, people forget, FTX's unraveling and problems with the Terra Luna stablecoin, that preceded the run on SVB. Silvergate was a bank that was very big in crypto, and it nearly didn't fail, but it came close. And its near failure was the proximate cause of the run on SVB. It caused people to see interest rate risk in a new way. So the risks here around US dollar stablecoin are that we end up in a situation where a non-Genius Act compliant one depegs. The largest one is, I'll just say it, Tether, is not Genius Act compliant. There's a loss of confidence, and people run on all of it because they can't tell the difference, which is just like what we see in the banking sector, and we've seen this in money funds too. Consumers, they are not intending to be creditors when they provide a bank deposit or own a stable coin or involved in a money fund. They just think they're parking their cash there, and that the dollar they put in will be the dollar they get out. And if they start to doubt that in any way, they shoot first and ask questions later, and they take all of their money out. And I'm not trying to criticize. That's the dynamic of contagion and networks and runs.
The funny thing is, I mean, obviously it's unfortunate and potentially destructive to the financial system, but it's a completely reasonable reflex to feeling like your money's at risk. And I think that's actually really a good point. And I think it puts maybe helps us to put a point on this part of the conversation very easily. Most people, and this is your whole idea kind of condensed. Most people, when they deposit money in the bank, they aren't intending to be creditors or investors in whatever assets the banks decide based on things that are not necessarily transparent to their customers. They're not intending to participate in those investments. And the other thing is, because of the deposits they make, they're not actually entitled to most of the upside to begin with. Like, the bank is going to put that on its P&L statement and shareholder value, but it's not necessarily going to redound to a depositor. And so those are the things that, like, those asymmetries are the unacknowledged transfers of risk that concern you.
Right. But so this is why bank regulation needs to be effective. Okay. And this is why when I see things happening in bank regulation and supervision, it's both of them together. Right.
Yeah.
You can't, I do feel that we have a tendency in the United States to put people with legal backgrounds into, leading roles in our bank regulatory agencies at the federal level. And then we're surprised that they don't have a strong understanding of risk, and they think that they can regulate everything and write a law for everything, as opposed to, either training supervisors or alternatively, really making bank management own the decisions, right? Making bank management and bank boards accountable for risks they take. Now, I view banks as they get deposit insurance, and we provide deposit insurance to banks because banks perform a crucial socially useful function, which
Right.
is they take short-term savings and they make loans, and those loans grow our economy. Community banks, William, for example, community banks, probably about 70 to 75 cents on every dollar ends up in lending, and a lot of it ends up as small business loans.
Yeah.
And small businesses are essential. They employ over 50% of U.S. workers. So, like, on the one hand, I hear where you're coming from about like depositors don't get the upside, but as a society, we get upside when banks are well regulated and supervised,
Right.
in terms of economic growth.
No, that's a point well taken. I concede it. That actually, you're right. That the aggregate upside is important. Everybody gets to
Right.
participate in an economy where goods and services flow freely and they're fairly cheap, and we all, and we in the United States, at least, for the last 10 years, unemployment has been so low that we've forgotten that unemployment is a thing. It's like those are things that we get because of that. And I of course can see that point. It's just that that actually that. That for that reason, the lack of it's for that reason that we become actually pretty vulnerable as as a banking system that performs this function for people who don't know how most of it works, and so the systemic, we think that like if you just regulate mortgage-backed securities, you've solved the 2008 problem. And what we fail to realize so often, I think, is that actually there are lots and lots of ways for banks to do that very thing. And there are lots of ways for them to invest in volatile assets whose sudden shifts in value become systemic risk. And so things like the liquidity coverage ratio, things like the Basel III framework, all of those things are meant to ensure that banks can't actually ignore the multiple sets of interests that they must manage well, not just their own shareholders, not just the governments and societies' vested interest in having liquidity provision, but also the people who invest in those banks. And I generally think that that regulation tends to overshoot, but I don't necessarily think that bank regulation is a thing we can afford to take a laissez-faire attitude to. We need to make sure that that those things stay locked up, and I think that's really what's interesting. That's what interested me about your congressional testimony, and it's part of why I wanted to talk to you in the first place. Is that you're a person who says, look, for example, quantitative easing, to the extent that we did it, was a bad idea, but we don't just get to try to put the toothpaste back in the tube now,
Right.
with quantitative tightening, which is actually going to create the very crisis that we are trying to avert. And I wish I could talk to you all day about that. I want to get to one more thing before I let you go, because I think this is the thing that really, from your testimony before Congress and also your published work, I think is so interesting to me, because I didn't perceive this link and I want to know more about it. You've written on the relationship between the systemic financial risks and government fiscal policy on several occasions, and you testified on this point. I have to say, basically, sort of alone. You stood pretty much alone before on a panel full of people who were saying that the problem, like that the solution to treasury market liquidity was to allow banks to exclude it from their coverage ratios. And your testimony was like, actually, that the way to
exclude it from their leverage ratio.
Their leverage, yes.
To not have any capital against even long duration government bonds, which as we know from SVB, whose prices can move. But continue. Mm-hmm.
Right. Anyway, so that and you said actually the best way to ensure sufficient treasury market liquidity is for the U.S. government to eliminate its addiction to debt. And so I just want to hear you speak for a moment about the connection between fiscal policy, the U.S. government's addiction to deficit spending, and the relationship of that to the systemic financial risk and to bank risk. Those things that's a counterintuitive connection. I am very interested in it, and I want to hear. I would love for the people who listen to this show to be able to hear you say more about that.
So, fiscal dominance is the idea that when government debt stocks become too large, that we both pressure the central bank in terms of how it sets interest rate policy and how it conducts monetary policy overall.
Yeah.
And we also change the regulation of banks and other financial institutions to facilitate the funding of an excessively large government debt stock. It is my sincerely heartfelt belief that we have a problem, a generational problem in terms of leadership in the United States with regards to fiscal policy. We have lawmakers of both parties who have maxed out the U.S. credit card. And now, as opposed to, and I'm going to say something as well about our, I'll call it entitlement programs. We have programs, Social Security, Medicare, where elderly Americans, and this is not meant to offend anyone and it's not meant to accuse anyone, it's just a state of fact, are being paid levels of benefits that exceed what they contributed.
Mm-hmm.
And they exceed what they contributed because the demographic assumptions were too favorable, meaning that it was assumed that people would die earlier than they have actually. And again, that's on the one hand, a happy development, but that needs to be adjusted in the formula, and it's not been. Okay. So we are on a fiscal path. We are currently at a government debt to GDP level akin to the end of World War II.
Yeah.
Projected, I just went over this with my students in class, in my macrofinance class, projected by CBO in its most recent release Congressional Budget Office that we will be at easily 120% to GDP. I respect CBO's work, but despite my respect for CBO, they have tended to consistently underestimate where we
the assumptions are always a little rosy.
Yeah, they have consistently underestimated where we are going to be. We are 6 years away now from basically exhausting the Social Security Trust Fund.
Right.
And yet the talk of Treasury market fragility revolves around how do we come up with, I'll call it, William, cute ways, whether it's central clearing of treasuries or changing bank regulation, or, and this discussion that you and I just had around the Fed's balance sheet. Why now do people care about bringing the size of the Fed's balance sheet down when they didn't care as much, I'll say, back in 2014 or 2016? They care.
That's the beginning of fiscal dominance, you think?
Right, because banks are getting paid interest on reserves. And they'd like to not pay banks interest on reserves. So they want to shrink the size of the Fed's footprint to reduce what banks are paid. We also are having a discussion about some share of bank reserves maybe not even getting paid interest.
Mm-hmm.
Instead of addressing the fact that we need to have a comprehensive review of everything. Tax rebates are a form of spending, actual spending, looking at, I'll call it entitlements. Okay.
Yeah.
All of that needs to be on the table. Instead of having that honest conversation, we dance around and we tell the American public that we're going to have a positive productivity shock from AI that's going to fix all of this. This is nonsense.
Yeah.
This is nonsense. Yeah. And it is wasting time about addressing the real macroeconomic issues this country faces. And I find it, I'm concerned for young people in our country.
Yeah. I'm so eager to talk about that. I know that I really do want to respect your time, but it's so interesting, and you keep saying interesting things. When I think of the last time that the country had a decided and concerted effort to get its finances in order was the 1990s. And when I think about like the analogies and disanalogies between then and now, I think, for example, that we had both tax raises and spending cuts in the 1993 Budget Act. We had resulting declines in interest as credibility was largely restored, and also we were lucky then that we kind of experienced an economic and technological moonshot because of the dot-com boost. And basically, the only one of those scenarios that even might be relevant to right now, just in terms of like what's politically feasible and what's likely to happen in the near future, is that last one about a technology boom. And there's a chance that I think. I think I think that our lawmakers are mostly gambling on that to happen.
Yes.
They're mostly gambling on, I mean, I remember during the presidential primary season for the last election, basically every single person who was challenging the president for the Republican nomination was the current president for the Republican nomination was saying that the answer to our fiscal solution is to grow our way out of it. And they were by speaking in terms of things like 5% real GDP. There's no way that's going to happen except that AI creates the kind of productivity per unit that we have never ever seen. And to be fair, I think there is it has to be admitted that there is a distant chance of that. But I think that there are really important factors weighing against it. And in any case, most of our lawmakers see sudden revenue provision either through a greater tax base or through just a greater tax rate, whichever side of that debate you're on. They see that primarily as a way to engineer new programs. I'm thinking now of Senator Sanders recently introducing a new tax on the ultra wealthy and every single line of that tax is meant to finance something new that he thinks the government should be doing. Now, most people think that that's just politics. It's about midterms, whatever. The point is, though, when our lawmakers currently think about sudden infusions of revenue in any way at all, they're already spending it again. And the point is that you want to make is that because of the balance sheet, because of the amount of treasuries in circulation that have to be rolled over, it's already spent. And so even if the government was to decide we want to get our fiscal house in order, the only analogy to the 1993 situation is the hope for a technological moonshot that may or may not happen. And morally, even if it does happen, this is where I think the force of what you were just saying, it's dubious at the very least to bet on it.
So again, I think that we have an older generation that is perfectly happy to gamble for resurrection and not change anything that affects, I'll say, the trajectory for the rest of their lives. And I will also say that AI, there's still, I think, a debate. From what I can tell so far, at the aggregate macroeconomic level, AI has not meaningfully shifted the job picture. That could change. And if it does, that will fall on younger generations too. Mm-hmm. AI, as we know, is very energy hungry. It's very water hungry. These are basic necessities. Okay. Yeah. So it's not like AI it's not like the internet. It's not infinitely scalable like Google, where costs don't scale. AI, every query that we do in ChatGPT or Claude, it consumes real resources, right? Mm-hmm. And so this is kind of what I object to, is that if you look at the history of countries that have faced, I'll say, high debt burdens, you would be challenged to find a situation that did not involve, in terms of them getting out of it, fiscal reform, fiscal consolidation. And yet we continue to have this nonsensical discussion like that productivity alone is going to save us, economic growth alone is going to save us. I will tell you another thing, William. I'm sorry. I get very, as you can tell, exercised about these things. But stablecoin, the risk of stablecoin is that it drains deposits out of the banking sector to fund T-bills. Yeah. That is the essence of government crowding out, because if you believe in, what I said earlier, right, that banks, particularly our smaller banks, are lending to support businesses and jobs in the real economy, this is the essence of government crowding out. This is why, we're putting Band-Aids as opposed to just saying stop and let's have a real conversation as a country about how do we fix this.
Yeah.
And I will say one last point. Debt and the currency, when you don't have confidence in the fiscal outlook, you don't have confidence in the currency. And this has given rise to a proliferation of, first it was Bitcoin, Then we've had precious metals, and now seemingly some people think that stablecoin is like another kind of quasi money.
Yeah.
My point would be this: why is Congress spending time on stablecoin legislation or pushing on crypto as opposed to doing their job and fixing fiscal policy?
Right.
Why are they doing that?
Yeah, that's a fair question. And I think in some ways, like you've hinted at some of the answers to that question, but those are really unsavory. So I don't even want to think about them, even though they are what they are. I just think, let me just wrap this up with this question, because you've pointed out, now spent nearly an hour talking about the systemic risks to the financial system of current Fed policy, which happens, as you've pointed out and eloquently, I think, which relates to and exists in a feedback loop with irresponsible fiscal policy. So you have the potential of Fed mismanagement and congressional abdication. I guess my question is, you teach students. I mean, you teach people who are 20 years old. I think a lot of the people who listen to my show, they're not 20, they're 40, they're my age. They're people who they're running businesses and they've been raising children, and they've just started to look up, and notice that, like, hey, I finally get to the place in my life where I'm not living hand to mouth, and I'm looking around and going, my goodness, what is worth investing in? And I really want to hear, you've granted that there are challenges at the Fed and there are challenges in Congress, and that those challenges could be unbounded. I mean, there is risk, I think, of at the outside limit of a fiscal crisis. There's risk of a restructuring of American debt. Those are things that are genuine risks. On the other hand, those risks exist in a dynamic relationship to a world that isn't offering many other options. So, we probably have a longer runway than we are entitled to as a country, just because the relevant alternatives maybe aren't there. But I'm curious, I began this conversation with a question about whether the deal is still real. One of the things that I love about the work you do is that you have been a part of the institutions that have a partial custodianship of the social contract. What do you see, if anything, as a sign that the deal is still real? And what should my listeners be doing, now that they're achieving disposable income for the first time, or investable income for the first time, and now that they're thinking about their children in college, where are you thinking that that light is to be found in this situation, if it's going to be found at all? Do they all need to run for office? Do we need to get pitchforks in front of the Fed? What do you think is the way out here?
I think we have a big, I would say, imbalance in terms of generational power. I think that it's, again, I don't want to seem too political in what I'm saying, but I do think, William, that some of the, I'll say, cultural topics that people try to debate, to me, are a smokescreen for dealing with the issue of fiscal policy kind of run amok.
Yeah.
And, and excessive bailouts. I think that the uber wealthy have gotten used to the 2008. How many people were prosecuted despite getting, hundreds of billions of dollars worth of bailout? One person. And he was a mid-level person, and it was largely, not to be negative, but his prosecution for crimes in 2008 was largely irrelevant. So there was very little accountability. And we've seen, again, like in COVID, there was massive mismanagement of government resources in terms of, it was important that the government step in, but it wasn't well orchestrated. Okay.
Right.
So I do think that we have gotten to a culture where younger people in this country are not, and I'm not trying to tell people how to be politically active. I'm not trying to say one party or the other. What I am trying to say, though, is that we have significant economic issues.
Yeah.
And if you're not engaged in thinking about them and advocating for, I'll say, the longer run future of this country, and we leave it to people who are perhaps nearing the end of their lives, we may end up with macroeconomic outcomes that are not favorable to the U.S. And I think we all have an interest in being active participants in this discussion of how do we fix the real
Right.
issues that we have in the U.S. And we need to do it in a respectful, constructive way with each other. But everybody needs to engage, and I think particularly people 40 plus, and they all need to engage. You were asking, I think, kind of implicitly as well for investment advice. And I do think that, as we've seen, we've been 5 years. Go ahead. Did you want to say something?
Just that I meant, I mean, I'm happy to hear whatever you have to say. I definitely did mean investment in the lowercase I sense, in terms of like where should we put our energy and resources on behalf of a future, not so much about like,
Got it.
I think I'm curious, I'm curious what you were going to say, but I just want to make really clear that, that's for me. I think, most, the sorts of risks that we've been describing are tail risks for every single asset class in the known system. A stagflationary regime you talked about, right, is a decline in stock prices and bond prices, and therefore implicitly, literally everything. Equities and debt. That's what there is. So the other thing is,
commodities tend to shine in these moments.
yeah, right. Defensives and commodities might do well in that kind of regime, but the stagflation caused by a long-term government finance problem isn't likely to be resolved cyclically. So I think when I say investment, I think that a lot of people might hear this conversation and see that and question like investment across the board. And so I'm curious what you were going to say, but I just want to clarify, this isn't necessarily about equities and debt financing,
Got it. No, thank you. So in terms of like investing your time and where to put, your, I'll say chips, I do think that it does involve some generational change in terms of the political structure. I think it involves people who are not interested necessarily in being career politicians. I do think that we've seen, I'll say, some mobilization of people into Congress out of concern for some of the things that are happening in the U.S.
Yeah.
I have met a few of those people, but I've also met people who really lack any, I'll say, economic background, and maybe are more mobilized on social issues, which
right.
I kind of, again, not to say that social issues are unimportant, but I do view them as more things that are kind of, to some extent, are at risk of being used to obfuscate or not address these resource transfer issues and income inequality issues that have gotten pretty significant in the United States. So I think you have to be willing to go in and, again, not treat it as a career, focus on the key issues, not every issue. Really engage, hold people accountable. Those are some of the things that I guess I would say, and to try to keep building businesses that provide useful goods and services. I think that's also a valuable way to contribute to this issue or problem, because that will grow the economy.
You pointed out that in an economic regime where all of the financialized assets are losing their value, that commodities do well. And I think by analogy, you can say like investing in the real economy is a cyclical and a counter-cyclical strength. So that there's something to be said for people who don't feel or don't feel either able to or just aren't willing to engage in the political system, because it can be very toxic. I mean, to believe me, I work in Congress, it is, but at the same time, that the other thing to do is like to look around and look for actual things that are of use and provide them the best that one can.
I will also say that, and this may sound controversial, but having children. I think we've been conditioned to believe that we can financialize our way out of old age. We can, we don't need a family. We can just money will meet all of our needs, and that this is also sort of its own shade of nonsense. I think Kant's Kant is useful to think about here. It's not a universifiable truth. that if we all decided to not have children and just rely on our retirement savings, the country and the economy would collapse. That's not a viable solution because we won't have any labor force in the future.
Right.
So I just do think that we need to recognize as well that, focusing on our families, raising successful families, building businesses, and engaging, all of these are like 3 steps that we can do to help.
I think that's as good a last word as any that's going to happen. Thank you so much for joining us today, Professor.
No, thank you for inviting me, William. As you can tell, I think these are super important issues. I'm grateful to you and your team for raising them.
Thanks for listening. If you enjoyed today's episode, leave us a 5-star review on your favorite podcast platform, and don't forget to subscribe to the show. Want to dig deeper? Follow us at millennialdebt.org for more insights, updates, and ways to be part of the solution. Thanks for listening.